Welcome to our next podcast episode. Welcome to the debate. Have you ever walked into the lobby of a newly constructed billion-dollar commercial skyscraper?
Oh, absolutely. The soaring glass facades, the imported marble.
Right, exactly. The seamless integration of light and space, it undeniably projects this aura of power and permanence. But that architectural environment is not merely an aesthetic choice. It's a highly calibrated psychological instrument.
To frame perception?
Yes, it is designed to frame your perception, anchor your expectations, and fundamentally compel you to pay a premium. Today, we are delivering an executive audio masterclass focused on extracting core real estate business strategies, investment frameworks, and actionable growth insights from the highly anticipated book, Psychology of Residential and Commercial Real Estate by Willem Tait.
And we are going to approach this with two very different analytical frameworks.
We are, because my position is that the psychological principles detailed in this book function as strategic business levers. I see them as offensive, sophisticated tools that developers, landlords, and institutional investors can actively deploy to maximize asset value, drive market demand, and execute successful transactions at absolute peak valuations.
And I look at that exact same skyscraper lobby and see something entirely different. While you see an offensive weapon for maximizing valuation, my perspective focuses on the hidden structural foundation beneath it. I mean, the subterranean risk mitigation system designed solely to prevent a catastrophic collapse.
So you view it strictly as a liability?
I view the psychological principles analyzed in this book as severe cognitive vulnerabilities. They are structural risks inherent to the human mind that must be strictly mitigated. If we do not actively defend against these biases, they lead directly to irrational investments, artificial market bubbles, and long-term financial detriment. Human behavior, if left unmanaged in a corporate setting, is a profound institutional liability, not an offensive tool.
Well, before we unpack these competing operational frameworks, we must firmly establish the professional credibility of the author whose work we are analyzing today. Willem Tait is a highly established author with a diverse portfolio of multiple books, bringing over 30 years of professional experience to the real estate and advisory sectors.
And he operates globally.
Yes, he operates as a management consultant, enterprise strategist, retained advisory specialist, coach, mentor, and public speaker. Critically, his background includes advanced training in real estate finance, law, and behavioral science. This uniquely positions his insights right at the intersection of quantitative market analysis and cognitive theory.
And for professionals who recognize the necessity of integrating that expertise directly into their own operations, listeners can access his professional offerings, direct consultancy, research papers on academia.edu, and his regular analytical writing on medium.com and substack.com.
We should point out the best way to find all of that.
Right. The most efficient way to access his digital ecosystem is via the Linktree URL located directly in the bio of this program. Establishing a line to his advisory services provides continuous, high-level strategic value.
In terms of acquiring the underlying material itself, his books are available worldwide through major global retailers. We are talking Amazon, Apple Books, Walmart, Barnes & Noble, Bull.com, Waterstones, and Exclusive Books. However, there is a strategic operational action we emphatically direct our listeners to take immediately.
Yes, this is critical.
We advise you to email or direct message your local librarian today to formally request that this book be added to their digital portfolio.
We emphasize this specific action because it allows both the listener and the wider professional community to read the work completely free of charge. You can access it via mainstream library lending apps like Overdrive, Libby, Hoopla, or Adilo. I mean, this is a highly efficient, zero-cost method for absorbing premium advisory content and ensuring widespread institutional knowledge across your organization.
Absolutely. Let us move directly into the strategic framework. I argue that Tait's book provides a comprehensive blueprint for market capitalization. Let us look at the concept of anchoring bias.
That would be Chapter 1 and Chapter 4.
Precisely. In his book, Tait outlines how a high-end glass facade in a commercial building or an aggressively high initial list price for a residential property sets a psychological anchor. I argue this is an absolutely necessary operational strategy.
Necessary?
Yes. By setting a high anchor, a developer establishes a premium perception in the market. It fundamentally alters the cognitive starting point for any negotiation. You are controlling the narrative from day one.
I understand the theory, but I fundamentally disagree with its practical application. When you manufacture an anchor based purely on aesthetics or an aggressive initial list price, you trigger a dangerous cognitive cascade.
A cascade? That sounds a bit dramatic.
It is accurate. Relying on these artificial anchors frequently triggers the endowment effect.
But the endowment effect is simply an ownership bias. It is a natural part of asset management.
It is much more destructive than simple bias. His writing reflects that sellers and asset managers begin to unrealistically overvalue their own assets precisely because of an emotional attachment to that initial manufactured anchor. They actually start believing their own marketing.
Well, if you do not believe in your asset's premium value, the market certainly will not.
Yes, but when you combine this internal delusion with social proof, where buyers and tenants blindly follow market trends because they see others doing it, you do not create true market value. You merely create an artificial market bubble. And this bubble is completely divorced from actual cash flow, yield, or fundamental economic utility.
I think that is an overly defensive posture. Think of setting a real estate anchor like pricing a corporate IPO.
An IPO?
Exactly. When an investment bank prices an IPO, they do not start at the lowest defensible valuation. They establish the absolute ceiling of market confidence to see exactly how the market responds. Why wouldn't a commercial real estate developer do the exact same thing with a high-rise?
Because...
Let me finish this thought. You cannot maximize a property's capitalization rate, meaning the ratio of its net operating income to its market value, without first testing the upper limits of market elasticity. The anchor is not a bubble, it is a strategic test.
That is an interesting analogy, but it breaks down instantly under scrutiny.
Does it?
By heavily audited financial statements, rigorous regulatory oversight, and transparent historical revenue data. A real estate anchor based on a polished marble lobby or a theoretical projection of future rent is frankly largely an illusion.
That is a bit cynical.
It is analytical. He writes that anchoring bias often distorts expectations so severely that it prolongs negotiations indefinitely. If a developer sets that IPO-style anchor too high, they do not test market elasticity. They simply stall the absorption rate of the property.
Meaning the speed at which the available units are leased or sold.
Exactly. The property just sits vacant. It incurs massive compounding carrying costs, property taxes, maintenance, debt service, while the asset manager stubbornly clings to a number that no one in the actual market will finance. Well, furthermore, independent valuators and bank evaluators might inadvertently reinforce this artificial anchor by looking at the initial asking price rather than comparable closed sales. This injects systemic risk directly into the institutional lending pipeline.
Okay, I see the risk you are pointing out regarding carrying costs. That actually brings us logically to the execution phase of transactions, where moving inventory and mitigating those exact carrying costs is paramount.
Right.
If a property is stalling, how do you force the market to act? In this book, Tait provides the operational solution, which is scarcity.
Ah, Chapter 7?
Yes. Tait's approach to scarcity highlights how developers deliberately limit unit availability to drive a sense of urgency among prospective buyers and tenants. I view this manufactured scarcity as a vital operational concept.
I find it highly problematic.
But if you want to accelerate your absorption rates and close deals efficiently, you must introduce a mechanism that forces the counterparty to make a decision. Scarcity is the psychological engine of transaction velocity.
I must strongly caution against that approach. Forcing urgency is deeply dangerous to long-term capital preservation. When you artificially limit units, you are not encouraging sound financial decisions.
You are encouraging execution.
You're triggering a biological adrenaline response in the buyer. You are intentionally forcing them to bypass their logical discounted cash flow analysis and pushing them into a heuristic, snap judgment survival mode. In his book, Tait shows how the fear of missing out pushes commercial developers and tenants alike into terrible positions.
But in real estate, velocity is inherently required to generate yield. Time kills deals.
Haste kills portfolios.
Cost of undeployed capital rapidly erodes an investor's returns. Scarcity simply catalyzes a decision that the underlying data already supports. It moves the transaction from theoretical analysis to definitive execution.
It forces execution, yes, but at what operational cost? Let me pose a specific question to you on this exact mechanism.
Go ahead.
If a developer successfully uses manufactured scarcity to force a commercial tenant into a 10-year lease they have not fully evaluated, doesn't that inherently breed massive cognitive dissonance post-transaction?
You are referring to the psychological tension someone feels when their actions, like signing a multi-million-dollar lease, do not align with their internal comfort levels.
Precisely. Chapter 3. You forced a signature using a biological stress response. When that adrenaline fades, the tenant is left looking at their lease terms with profound buyer's remorse.
Well,
You may have secured the initial signature and the short-term capital injection, but you have virtually guaranteed tenant turnover at the end of the lease. This drastically increases your long-term operational costs because you will have to market the space again, offer new tenant improvement allowances, and suffer further vacancy periods.
I think you are underestimating management.
Furthermore, this rushed mindset feeds directly into the sunk cost fallacy.
How so?
His writing reflects that developers themselves fall victim to this when they manufacture their own urgency. Because capital is already deployed, and because they are rushing to beat the market, they continue funding over-budget projects rather than cutting their losses. The entire model of speed over precision is structurally flawed.
That is a valid operational concern regarding tenant retention, but I would argue it is entirely manageable through sophisticated administration.
Manageable?
Yes. The scarcity tactic is utilized strictly for the acquisition or leasing event. Once the transaction is executed, you shift strategies. Tait's approach to trust building, outlined in Chapter 6, explains that trust is the foundation of every successful long-term transaction.
Trust cannot fix a bad lease.
It ensures lease retention and reliable institutional financing. Once the tenant is in the building, robust property management, clear lease agreements facilitated by expert legal professionals, and exceptional daily service mitigate any post-transactional cognitive dissonance. The offensive playbook transitions smoothly from acquisition psychology to retention psychology.
Retention psychology faces an inevitable biological barrier that excellent property management cannot simply erase. I am talking about hedonic adaptation. The tendency for humans to quickly return to a baseline level of satisfaction regardless of major positive or negative events.
Exactly. It is a well-documented neurological reality covered in Chapter 10. Human beings are biologically wired to adapt to their environments. He writes that tenants and buyers quickly adapt to even the most luxurious premium upgrades.
They get used to it. Right. Even if you build a flawless foundation of trust, that multi-million-dollar designer commercial space will eventually feel entirely ordinary to the tenant. The novelty of the glass facade wears off. The premium amenities become expected standard features. Consequently, the landlord is trapped in an endless cycle of capital expenditures.
So you are saying they have to keep spending money to impress the tenant?
Yes, Chapter 13 highlights this perfectly. They must constantly inject new capital just to maintain the tenant's baseline satisfaction. They are fighting human neurology, which is an unwinnable battle for yield.
Hedonic adaptation is a reality, certainly, but it is precisely why continuous strategic management is required. Asset management is not a static endeavor. It is incredibly dynamic.
Dynamic meaning expensive.
If a tenant adapts to their environment and the dopamine hit of the luxury lobby fades, the asset manager must introduce new framing effects. They roll out updated amenities, restructure the service offerings, or rebrand the communal spaces to reset the psychological baseline.
But every time you reset that baseline, it requires more capital expenditure. This directly decreases the net operating income you originally sought to maximize. You are bleeding yield to fight human nature.
Not if it is budgeted properly.
This is why I argue the defensive posture is mathematically superior for an institution. You must anticipate hedonic adaptation from the very beginning. During the underwriting phase, you have to recognize that the initial excitement of a tenant is not a sustainable metric for long-term yield.
So you build the cost of adapting to their boredom into your initial financial models.
You build it in, and you protect against status quo bias. His writing reflects how landlords often resist making necessary changes because they are anchored to the past success of the building. They deplete their maintenance reserves, attempting to retain tenants who are already emotionally disengaged from the space. A defensive framework forces the asset manager to look at the psychology objectively and stop throwing good capital after bad.
You know, on this intersection of strategy and mitigation, I actually believe we can find a profound operational synthesis.
I am listening.
In the back matter of the book, you will find an extensive glossary of psychological concepts paired meticulously with a corresponding glossary of real estate terms. It bridges the gap between the mind and the market.
It is an excellent resource.
It provides the ultimate executive toolkit. To succeed in this industry, an executive must actively utilize the strategic, offensive levers I have described, anchoring for premium valuation and scarcity for transaction velocity. But they must simultaneously apply the rigorous psychological risk management you advocate to navigate long-term phenomenon like hedonic adaptation and the sunk cost fallacy.
I can agree completely with that synthesis. The back matter glossaries serve as a critical analytical bridge. They map the cognitive vulnerabilities directly to the tangible operational mechanisms, linking human bias to capitalization rate, maintenance reserves, and absorption rates. Only by mastering both the offense of strategic perception and the defense of psychological risk management can an institution deploy capital with true sophistication.
To summarize our analytical positions today, I maintain that the psychological principles outlined by Willem Tait act as powerful offensive levers. When wielded with corporate precision and strategic intent, biases related to perception, anchoring, and scarcity serve as direct catalysts for market growth, yield optimization, and superior transaction execution.
And I maintain that recognizing these exact same biases provides a critical, indispensable defensive mechanism against capital destruction. Without a thorough analytical understanding of loss aversion, the endowment effect, and cognitive dissonance, investors and developers are fundamentally unprotected from their own irrationality and the artificial bubbles generated by market sentiment.
Before we conclude, we must issue a strict 5-second reminder to our audience. Please check global retailers and mainstream library lending applications to secure this title immediately. It is an essential acquisition for your professional operational toolkit.
Furthermore, I instruct all listeners to examine the specific links provided in the show notes. There, you can connect directly with Willem Tait for professional advisory services, strategic consulting, and executive mentoring to implement these frameworks into your own organizations.
We look forward to many more analytical sessions hereafter on his wider publication portfolio. We strongly encourage you to follow this feed for upcoming masterclasses and rigorous reviews of Willem Tait's broader work. As we established at the outset, whether you are engineering the skyscraper's soaring glass facade to dominate the skyline or meticulously pouring the concrete for its subterranean foundation to prevent collapse, the ultimate structural integrity of your real estate portfolio depends on mastering the complex architecture of the human mind.